Thank you, James.
Right, good morning, everyone. Okay, so my name's Anthony Rushworth, and I'm one of the founders of Homegrown.co.uk, which is a property crowdfunding platform. We specialise in giving people the opportunity to invest equity in property development projects, which is sort of previously reserved for institutional or professional investors. And the idea of Homegrown is to try and make that available to everybody, and access returns of over 15% per annum. So if we just start using 5 minutes to talk through a little bit about crowdfunding and then a bit more detail about Homegrown itself. So crowdfunding, what is crowdfunding for those who perhaps not familiar with it? It's the term that's used to describe the process where a number of people pool their money together to invest in property, invest in an asset, in this case, property. The market has, crowdfunding as a concept's been around for a while, but the market's been growing rapidly over the last few years. At the end of 2015, it was estimated to be worth 3.2 billion, and the market had grown by 80% that year. So it's a fast-growing area of the industry. Now, there's three main reasons that are cited for that growth. One is the level of returns that crowdfunding platforms are able to offer at a time when global interest rates are obviously at an all-time low, and people are sort of looking for somewhere to put their money. Two is the regulation. So the market benefited greatly over the last couple of years from the Financial Conduct Authority starting to regulate the industry. And the third one is around transparency and control. So one of the big things that the sort of new wave of digital platforms do is give people the opportunity to see all of the data, all of the information about an investment opportunity before they invest. And then they have the ability to choose which investment is right for them, whether it be by return or by location. And that's something that perhaps wasn't available with sort of traditional financial institutions. So what's Homegrown and where does Homegrown fit into that? I think the easiest way to try and explain that is with an example of how a sort of property developer, a mid-sized property developer, would traditionally fund a development project. So we would normally see a developer looking to raise finance. That'd be around 65, maybe 70% of the overall development cost, so the land and build cost. That could come from a bank, that could come from a peer-to-peer lender even, but it's typically debt. And then you've got the sort of remaining 30-40%. Now, that can either come from the developer themselves with their own capital, depending on the size of the project, obviously. But where it's a slightly larger project, that would typically come from a sort of network of high net worth or wealthy individuals. Okay, so what Homegrown does is effectively become one of those individuals. So we reserve a position with the developer, say 100,000, and then rather than turning around and offering that to one individual, we offer that to our investor base and allow, say, 100 people to put £1,000 into this project. But they're investing on the same terms as the institutional and professional investors. That's the key point. Okay. We only work with established developers. We do a huge amount of due diligence over projects before they make it onto the platform. My background's with PricewaterhouseCoopers, PwC, and I was a sort of real estate advisory role with them, and that's what I did basically. That's sort of where this thing started. As I mentioned, we try and structure our deals so that investors are investing alongside sort of institutional professional investors, and we are regulated by the Financial Conduct Authority. Obviously, from the perspective of this show, it's a sort of customer-based business, really. It's an investor-based business, but the other side of the business is about the developer. So one of the things we hope to achieve and we've got ambitions to achieve with this is supporting developers to build more homes. The sort of one of the biggest reasons you hear from a developer as to why they're not building more at the moment, it's obviously quite topical in the press at the moment, is equity, lack of equity finance. So it's not the debt. They're able to access the debt, they're not able to access the equity piece because that's a lot more ad hoc, it's a lot less structured. And that's the piece we're looking to help them with. And that will allow them hopefully to build more homes, create more jobs, regenerate areas. That's the sort of big ambition. Quick example, on the site at the moment, we've got a project that we're funding which is in Hackney, London. It's 42 flats, it's a big commercial space at the bottom across 3 blocks. The developer's raising 25 million of development finance and about 6 million of equity finance, and we're one of those equity investors. The projected return's about 33%, I think, 34%, and the target investment term is 2 years. So I hope that gives an idea of the type of project that we're talking about. There's more detail on the website. My slides. There's more detail on the website about that project and obviously how the whole concept works. And also please have a look at the risk warning that's on there as well, to sort of get a view of any of the risks that come with investing in property. Last point, bring to a close, we're on stand 172 in the prop tech zone and the rest of the guys. We're also running a promotion today, just a simple, we put £50 towards your first investment if you sign up with us today. So anyone interested, if you are, come and get the code from us on the stand. And thanks so much for listening.
Okay, thanks Anthony. So